I will be talking about Chapter 14, C.F.A. Investment Management Certificate. Chapter 14 describe about the UK taxation system. The income, we will be talking about the income, the bands, basic, higher, and the additional. They will have its rate separately. The basic rate is 20%. From 2013 to 2014, April to April, until 32,000 and the £10, the basic rate is 20%. If you are aged under 65, you have 9,440 to be deducted as your personal allowance. So if you have £30,000 of income in a year, you deduct 9,440, which will remain in 20,560. On top of that, we apply 20%, which is gonna give 4,112 to be paid to HMRC on behalf of your tax in the year of 2013 to 2014. If you are 65 and the under 75, between 65 and 74, you have 10,500 of personal allowance. That's the amount to be deducted out of income before apply 20%. As the basic rates goes up to 32,010 pounds, if you are aged of 65 or over, every £2 you earn above 26 and £100, they will deduct £1 out of your personal allowance. Let's assume if you earn 26,180, as exceeded £80, they will be deduct £40 out of your personal allowance. Instead, you have 10,500, you will have 10,420 pounds as your personal allowance. But if you are under 65, every £2 that exceeded £100,000, they will deduct £1 out of your personal allowance. See the difference? If you are under 65, your personal allowance is 9,440, but you can go up to 100,000 without be deduct any penny out of your personal allowance. When it passes £100,000, then every £2 they deduct £1 out of your personal allowance. So the taxation is 32 up to 32 and £10 is 20%. From 32,011 pounds to 150 is 40%. Beyond 150 is an additional rate. 45% will be applicable on the amount that pass 150. So you got 3 bands to be charged Let's assume if you earn 160 up to 32 and the 10 pound, you charge 20. From 32,000 11 pound to 150, we apply 40%, and what exceeded beyond 150, we charge 45%. So you have all described. We'll be talking about also about the dividend. If you already earn your income is within the basic rate below 32,010 pence, 10 pounds, the dividend is 10%. Normally, when they pay your dividend, they already deduct 10%. So if you're earning on the basic rate, you do not have to pay anything. But if you are on the higher rate taxpayer, which is 40%, and you receive dividend, the dividend as they take 10% on behalf of the tax credit, you have to pay 32 and a half on top of the gross value of the dividend. Let's assume if they gave you 900 pounds, we assume that the dividend, the gross value was 1,000. So over this 1,000, we apply 32.5%, and we deduct that 100 pounds that the bank deduct before gave you 900 pounds, and this difference, which will be just about 22.5, you pay. To get this calculation, just take 900 pounds divided by 0.9, you will have 1,000. Then you apply 32.5. That will give you the net value for you, and then you pay the difference as you deduct those 10% that the bank has already been taken previously. But if you are an additional income, you pay 37.5%. The way to calculate is the same. Always divide the net received by 0.9, then apply the tax. If your additional rate 45%, which your income is over 150, you divide by 0.9, apply 37.5, and deduct what they have already taken, and you pay the difference. The difference going among your calculation, the whole all others income and all other taxation, all deduction, and then you make a single payment towards HMRC. Is you also have income that is came from save income, which is it's not dividend. An investment you make, you have the income. So the save income is taxed 10% up to the first 2,790 pounds. 2,790 is taxable at 10%. What exceeded is go to 20%. They all are 20%. Some banks, when they release the funds to you, they have already deducted 20% on behalf of the tax. But you have to consider that income as a gross income, but you don't have the right to deduct out of your payable tax immediately. To get the refund of that tax, you have to fill in the R40 within the period of 4 years, and then you hand the revenue, and they give you the funds back. Well, this calculation from tax for the years. You also have a capital gains tax. There is exemption until 10,900. Capital gains is when you bought any asset and you did not invest anything on it, and you sell it, it has a profit of up to 10,900, but you don't need to pay anything. But if it exceeded, and if you are in basic rate taxpayer, if you are basic rate taxpayer that you are paying 20% below 32,010 pounds, you will be paying 18% of that difference. What goes beyond 10,900, you pay to 18%. But if you are higher rate taxpayer or additional, you'll be paying 28% on top of the difference that goes beyond 10,900. The amount is charged above the exemption. If there is some asset that you sold and they had the capital gains on it, and the others you have losses, you can offset, you can compensate before you make any payment. We are also talking about the inheritance tax that has an exemption up to 325,000 pounds. Then anything beyond that, the tax is 40%. This is considered to who has property in the UK and but is ordinary resident. Ordinary resident is people who is like Portuguese or German who lives here, or even Indian or American, people who was not born here or has not got is not domiciled yet. Once the person domiciled here or is British or has a permanent home here, that's different. Those people don't pay anything on inheritance. But if the person, in the other case, the person is not permanent in the country, they pay 40% on top of anything that goes beyond the 325,000 pounds in a property. If a person dies and then all the estates that they leave, if the trustee or a person who is responsible for all the estate or the will, if they grant anything to a charitable trust which look after disability or disabled peoples, or the official charity, the amount that they give for these people, charitable trustee, they can deduct out of the chargeable estate. Like, let's assume a person has died and left to their children 500,000 pounds, and the trustee or one of the children, before be taxed, give 50,000 pounds to a charitable trust. So out of 500 that the 50,000 that they gave you, it's going to remain 450. So the person will be charged on top of 450,000. But on top of this 450,000, we deduct 325,000 pounds, which is the exemption that they have before charge inheritance tax. So 125. This 125 remains will be chargeable 40%. If one of the children decide to keep the house, they can pay those 40% divided into 10 years, which is 10% of the tax due a year. But they will pay also interest. So those 40%, they have 10 years times to pay. Or if they decide to sell the house, they can pay 10% of the tax due within the period of 6 months, and the next year, as they sell the house, they have to pay the full balance to HMRC. Whenever a person dies, the property will be passed on to his civil partner or spouse. Let's assume if a person dies and his spouse or his partner shares his partner, stay with the house and don't charge that amount, the full amount, 325. They can use 50%. And when the person died again, this remaining person, the survivor person, dies and passes the house to their children have the right to claim those 50% that the remaining parents left. So they can use 325 plus 50% that was not used previously, which goes to 487,500 pounds. And then what goes beyond that, they pay 40%. Once more, if a person is British, lives in UK, born and bred in UK, don't pay any inheritance tax. Okay, there's also GWR. GWR is standing for gift with reservation. If the parents give the house to their children but live in a house, it's not considered as a gift, because he still lives in a house. He make use of the house. Or if he gives the house to the children and they rent the house, but he take the money of the rent to himself, it's also more is not considered as a gift. But if he gives the house to their children and they live for more than 7 years, when he died, even if the house worth 800 or 700,000, the children are not liable to pay any tax because they own the house over 7 years. In this instance, they are free to pay. That's the only way. When they are discretionary made by a trustee to distribute asset, the heir are liable to tax. Like, if a person made a will before die and they nominated someone to look after his asset and they make a distribution to disabled people, anybody. So all those persons who is a beneficiary, they will be liable to tax. According to the PET list, PET, the potential exempt transfer, because the asset is being transferred for them. They have to pay at least the tax for it. If the person is a resident, the person who lives more than 183 days, that is considered a resident. Ordinarily, resident are those who have a right to stay here in the UK, but spend part of the year in other country. And they also have domiciled country, domiciled resident. Those domiciled are the ones live here permanently, are decisive to stay here until the end of their life. Those make a difference, because when you make a advice, when you advise people about investment and taxation, they will have to be said, because on top of it, the taxation is different. If a person lives here since you child, when he completes 16 years old, he can decide wherever he wants to stay, in UK, outside UK, and so on. A non-resident is liable to income tax only on the income arising in the UK. Non-resident is the ones are here for a short period of time, normally less than 5 years. The person who is a resident and receives foreign currency on behalf of his income outside the UK, they are also taxed. This person must fill in the RBC, which is a remittance basis charge, and is sent to HMRC. Well, it's talking about properties now. Residential landing or property. Residential land, they are taxed on top of its price. The price is paid on the occasion of transfer when the person buys. So residential land and the non-residential, they will have different rate of tax, right? So the residential land up to £125,000, which is there's no rent, there's no, the person doesn't pay anything. But if it worth from 125 and 250 as first buyer, they will pay 1%. If worth, the transaction was made based on the value of 250 and £500, is chargeable 3% on top of the price paid. From 500 to 1 million is 4%. Over 1 million to 2 million is 5%. Over 2 million are 7%. No residential with intention of renting up to 150 and the annual rate is under 1,000, doesn't pay any tax. This tax is called SDLT, stand for Stamp Duty Reserve Tax. Sorry, SDRT. Right. So the non-residential up to 150 annual rent over 1,000, they pay 1%. Over 150 to 250, they pay 1% as far as their rent is over 1,000. Normally, property or house or anything that is rent or no residential, the rent is likely to be above £1,000. So if the value of the property between 250 and the 500 is 3%. If over 500, 4%. It also has transaction that when you invest your funds outside the UK in equities or any asset outside the financial assets, you'll pay flat rate of 5%. Crest control it. Crest is a corporation that computerized system. They control over Europe all transaction, the shares, equity, and every investment that involves funds from one country to the other. And it also has a opened investment, open-ended investment, also flat rate of 0.5%.